Hello, everyone. Today on the final bar, I'll be joined by Bob Lang from Explosive Options. We'll talk about Fed Day. Happy Fed Day with the S&P, the NASDAQ accelerating to the upside. Quite a lot of volatility, sort of a quieter session earlier in the day. Big dip, big reversal back to the upside at the afternoon session. We're going to look at the S&P, the NASDAQ in a little more detail. Also, the impact of higher rates and what that might mean for stocks in your portfolio. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets today using the power of technical analysis, using the technical and behavioral toolkit to better understand what's happening around us as investors. Today's Fed Day. We had the Fed meeting yesterday and today. The press conference this afternoon by Jerome Powell, minutes of the meeting coming out. And quite a lot of volatility around that period. We'll do another segment later in today's show called "Don't Fight the Fed," where we'll focus on the impact or the potential impact, the projected impact of increased rate hikes or a series of rate hikes in 2022 and 2023. But today certainly both a feel of both markets. Right, you had the bearish reaction right after the minutes. You had the bullish reaction during Powell's press conference, just accelerating into the close. I think going into the final bell, you're still seeing the S&P and the NASDAQ pushing higher. The NASDAQ up almost 4% today. Challenge is this is still within a bear market phase, and I think that's where we have to disconnect the volatility, the movements of today, of yesterday, with the bigger picture. What would you need to see to recognize the fact that the market has rotated from a bear market phase to a bull market phase? We'll look at some of those charts together here. We have great guests on the show. I'm excited to talk to Bob Lang here in a little while. We also have Clint Cowles from TD Ameritrade coming up tomorrow on the show. Next week, we have Peter Brandt joining us on the show again. That's on Tuesday the 22nd. On Wednesday the 23rd, Roman Bogomazov from Wyckoff Analytics. Always does a great job educating us on the Wyckoff method. Couple quick announcements to share with you as well. Chart Madness is our March Madness stock picking exercise coming up next week on the 24th. You can join myself, Grayson Rose, Greg Schnell, Tom Boley as we pick a bracket of 16 stocks and come down to our final four and our projected champion. You can print your own bracket at stockcharts.com/chartmadness. Get in on the game as well. Also, I'll be doing my next free webinar from Market Misbehavior coming up next Tuesday, March 22nd. It's at 1 p.m. Eastern, called 5 Key Charts for Market Sentiment. What I will do is share with you things like the VIX, the RIDEX flows, things we share on this show, but we'll go into a little more detail about how they're constructed and what they're telling us about the current market relative to previous bear market cycles. Go to marketmisbehavior.com/sentiment to sign up for that free upcoming webinar. Let's continue on to our next segment, the market recap. Today's Fed Day, and I often quote Jesse Livermore on a day like today. There's a time to go long, a time to go short, a time to go fishing. This might be one of those fishing days, but we'll talk about what the market actually did. A lot of volatility, and that's the challenge for long-term investors on a day like today. It's a tough day to be making a lot of changes because there's a lot of volatility. Usually it makes sense to wait to see how things play out, see how things resolve, see what happens going into Fed Day, what happens coming out of Fed Day. So certainly finishing in a position of strength. We'll have to see, I think, how the remainder of this week plays out, because so far this week has really been about a recovery in growth, at least on the tactical time frame, right? On the short-term time frame, you're getting a lot of stocks bouncing higher from fairly beaten down levels. Today, consumer, discretionary, and technology both up over 3%. By the time the closing bell was rung, the S&P 500 finished up 2.25%, just below 4360. It's a long way from 4,200, which is what we were talking about as key support in this current range-bound market. The NASDAQ composite was up almost 4%, 13,430 or so. Mid caps and small caps all up as well, and outperforming the S&P, which is notable. It really hasn't been the case very often. And the VIX finally back below 30 on tomorrow's show. Is that right? Yeah, tomorrow's show on Thursday. We'll dig a little bit more into sentiment indicators like the VIX, but had been above 30 for quite some time, and now just below 30 today, given the rally that you saw in the S&P. Let's look at some other asset classes here very quickly. Again, later in today's show, we'll do a segment called "Don't Fight the Fed," where we'll dig a little bit deeper into the Fed's decisions today and the implications of the potential ramifications of the Federal Reserve policy, the FOMC policy over the next year or two. But interest rates ended the day a little bit higher, depending on where you look on the curve. The middle of the curve, sort of that 10-year point, finishing the day at 219 or so. Now, it had been up to around 225 just a couple hours ago, right? As the press conference starts, you're accelerating to the upside, and then kind of gave back. And essentially, by the end of the day, by the close, it had sort of given back all of that. The bond market had sold off aggressively. As the minutes were released, the press conference happens, and it gives back all of those losses. Bonds rally, and interest rates come back down. So again, certainly a volatile day. The dollar index weaker today, and we talked yesterday with my guest Samantha LaDuke about the stronger dollar environment overall, which I still see as the longer play here, but certainly some short-term weakness today. Gold prices, and I feel like all over the place is the official technical term I can give for most of these charts today. It was a volatile session. Gold prices were down significantly just after 2 o'clock, but finished the day stronger. And this is as Powell's talking about inflation and the prospects for what all the things they will need to do, the Fed will need to do to address inflation, and that means an inflation hedge like gold seems to do better. So you have weaker dollar, stronger gold, which kind of makes sense if we're worried about inflation. Finally, cryptocurrencies all across the top 10 coins that we follow, all in the green, with Bitcoin up just under 4%, around 40,830. Ether up almost 5% today as well. When you look at the two of those, Ethereum has been outperforming Bitcoin recently. It might be an interesting theme to pay attention to. A lot of times we think of cryptocurrencies as all one big thing. There's some differentiation between those different coins. This might be a good time to reflect on them. Let's look at a chart of the S&P 500 to continue on our discussion today. The S&P chart looks like this by my read. And by the way, I just wrote an article before the show, a couple hours before the show. If you go to the articles tab, you'll see my most recent article, The Two Directions for the S&P 500. I would encourage you to check that out because I'll have a lot more time to dig into some of these things that we're going to talk about here briefly. But I see the market as essentially, in a consolidation phase. If you asked me to pick a trend in the market, I think the trend is still overall down. But there's enough mixed messaging in the short term to recognize the fact that the markets are sort of consolidating. One piece of evidence of that is that the RSI is right at 50. It literally was bouncing around from around 45 up to 53 or so during the course of the trading day today. Every time I glance, it's sort of at a different level. But the RSI being at 50 essentially means the absence of momentum. The way that the RSI is calculated is it looks, and I'm completely summarizing the math behind this. I'm giving the easy version. Is basically what's the average up day and what's the average down day. Meaning when the stock or when the ETF closes higher than yesterday, how much higher does it tend to go? When it closes lower, how much lower does it tend to go? And the RSI is essentially a ratio of the average up day to the average down day. Now it uses a lot of smoothing techniques like exponential averages to smooth out that data over time. But at the end of the day, that's really what the indicator is measuring. So when the RSI is right at 50, it essentially means that up and down days are in equilibrium, right? Or even for every up day of a certain amount, you kind of have a down day of a certain amount over a particular look back period. That's kind of what that is implying. And what that means when the RSI is at 50 is we're dead neutral, we're in the middle. Now what's interesting is you've had a bullish momentum divergence January into February, lower lows in price, higher lows in the RSI. A lot of individual stocks have shown a very similar look. You also have had a downtrend in momentum that is arguably, as of today's close and yesterday's close, sorry to break. If I take a trend line using the RSI values recently, you can see today's close is pushing us above there. Where you have not had the upside follow through enough is in price itself. So when I'm taking a trend line of the high prices in 2022, we're not there yet. Now today we got closer and closer to that. We get above 4,400 through the remainder of this week. That would take us above trendline resistance. That would take us above the previous swing high on the S&P 500. Also would most likely, I think, I think absolutely would make the my market trend model on the short term turn more bullish. And so that would be a more encouraging look for this market if we would actually follow through on a price basis. Now, continuing on our discussion of what's happening today, we talked about breadth conditions yesterday. Now, these breadth readings are going to jump today, so brace for that. But I don't think they're going to bounce enough to really change the configuration of this market. This is one that I looked at last week with Jonathan Krinsky from BTIG. We looked at a similar chart to this. We looked at the percent of stocks above their 200-day moving average, and his point was in really bombed out bear phases. When a bear market really has a chance to play out, this indicator usually gets a lot lower, meaning even more and more stocks are trading below their 200-day moving average, which is what the S&P itself is doing, currently below both moving averages. Right now, it's about 4 out of 10 of the S&P. Given the bounce that you saw today, I would expect that indicator to go up slightly. I don't know if it'll go up significantly. And as long as that remains below 50%, that still tells you we are in a bear market phase. So don't confuse the short-term movement we're seeing today with a longer-term structural shift. Now, what you did see today, and again, just to wrap up our market recap on today's trading, consumer discretionary and technology both up fairly significantly, with financials, number 3, up 2.8%. What was down today? Only 2 sectors: energy down 0.5%, utilities just below zero, and staples just above the zero line. So consumer staples and utilities, certainly some very defensive sectors. So what I would see today is very much an offense over defense, certainly a tactical move to the upside for growth stocks. The ongoing question, is it enough to change the character of this market? I would argue we're not there yet. Let's take a quick commercial break. We'll be back with my next segment. See you in a minute. Back to the final bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using technical analysis and data visualization techniques to better quantify investor behavior. A couple quick announcements before we get to my next segment. First off, we welcome your questions. We'll do another mailbag segment on Friday's show of this week. We'd love to feature your question live on the air. You can get your questions to us 3 ways: via email, thefinalbar@stockcharts.com, via Twitter, @FinalBarSCTV, via YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions, hope to answer one of yours live on the air in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free. Special events like Chart Madness, Market Outlook specials from Larry Williams, Martin Pring, and many, many others. Special guest appearances all along the way, all for free at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. Our next segment is Don't Fight the Fed. I mentioned the Federal Reserve meeting today, yesterday and today really, Fed minutes coming out, and then Powell's press conference. So a lot of volatility. Let's talk about what happens on a Fed day and how to think about the noise of today. And I would argue a lot of what you saw today is most likely noise versus the longer term trends. So when the Fed meets, right, you have a series of preset Fed meetings that have come out. When we're looking at the Federal Reserve, I immediately want to look at the chart of interest rates. It's immediate when I'm saying Fed in my head, I'm looking at this chart, the $ TNX. This is the 10-year Treasury yield, and it's a really good way to just think about the interest rate environment over time. Now, what I'm going to do is bring in an extra year. Let's go like 3 years. And I think with interest rates, looking at a little longer term perspective can be helpful, especially when you're thinking about the Fed, because the Fed had a meeting this week, had the announcement today, which is causing some dislocation in the markets. But you have to remember, the big part of what people are pricing in when you're thinking about the Fed is what the Fed is going to be doing over the next year or two, right? So we're now facing the prospect of 7 rate hikes during calendar year 2022, additional rate hikes in 2023. That would put the Fed funds target rate, even if you just do a minimal change there, that's putting the short end of the curve up above 2%, getting up to 2.50, 3%, depending on how aggressive they're changing their interest rate policy. That's a lot. That's a long way from essentially zero, which is where the Fed funds target rate has been for so long. So the way to think about the Fed is, again, the comments that they're making, what is significant in their thinking in terms of how they're adjusting interest rate policy, and then where things are potentially going to be headed over the next year or two. The expectation then is that interest rates most likely, and again, I don't see a scenario where it does not happen, where interest rates go higher. My conversation yesterday with Samantha LeDuc was really informative, and if you missed that, I would strongly encourage you to go back and talk about that, because she did a great job of just describing the overall broad headwinds and tailwinds given what the Fed is most likely going to do. If the Fed follows through on what it was implying today, and certainly in the press conference after the meeting, minutes were released, 10-year yield goes higher, 30-year yield goes higher, target rate goes higher, and over time, what that does is it makes this chart continue to appreciate. What happens when rates tend to go higher? Well, there are a number of ripple effects that we can think about given higher rates, and one of the most important ones is looking at growth versus value. And what I want to do here is look in the Mindful Investor Live chart list. I have a pretty good chart, if I remember right. Here we go. This chart is looking at 10-year yield, and then it's looking at value versus growth in the bottom panel. So this is that same chart of the dollar sign TNX going back around 3 years. At the bottom, it's the ratio, the relative performance of RPV, which is a value ETF, RPG, which is the growth ETF. There's the Russell value versus Russell growth. So if this line is going up, value stocks are outperforming. If this line is going down, value stocks are underperforming growth. And again, flip that over and you get the leadership or laggardship in growth stocks, technology, consumer discretionary, and communication services. So what's been happening really since mid-November? Well, we had interest rates come off a bit after coming higher and then really rotating to the upside. So look at how the period of rising rates from mid-2020 to early 2021, rates going higher, value stocks outperforming. This is when the cyclical sectors like energy and materials are doing very, very well. You then have that period in the middle of last year when growth stocks started to do well. This is when we're talking all about the FANG stocks, all about the re-emerging leadership in mega cap tech and consumer. This is when rates are coming down, and that tends to be a much better environment for growth names. Then we see rates starting to rotate higher. And again, it took a little bit of time as the things sort of fluctuated, but at the end of this chart, in the last quarter of this chart, as rates continue to accelerate to the upside, we have value stocks outperforming. So you can see there's a pretty close relationship between interest rates and which types of sectors, which types of stocks are outperforming. And that's just because of what that interest rate environment sort of means. Higher rates means the growth prospects of growth stocks are less attractive than what they would be if rates are going down. So higher rates, tailwind for cyclical sectors and things like financials, headwind or a negative sign for something like a growth stock. So if the rates are potentially going to be going higher, which I think they most likely are. If the Fed continues to raise rates through the course of this year and into next year, most likely this chart goes higher, and you can then make the assumption of what that means down here, which means if you're looking right now and you're buying the NASDAQ, then you are basically assuming that everything I just said is totally wrong because you're assuming that growth stocks are just going to rip to the upside in a rising rate environment. And I have to tell you, that'd be an incredibly unusual and unexpected outcome. Let's look at a chart of the NASDAQ composite and just think about what has happened. We talked about rates going higher. We've seen how the NASDAQ has gone lower. This jump that we saw in growth stocks today and the move that we saw yesterday, this is after the NASDAQ composite made a new closing low for the last 12 months. We're all of a sudden right back where we were in March of 2021. That's where we were on Monday's session, right? The sell-off on Monday pushed us down to that level. Oh, sorry. Yes, that's right, Monday. Tuesday and Wednesday, we see growth stocks outperforming value, and this is why I would tend to think of this as a mean reversion sort of move. If rates are going higher, growth stocks are most likely going to struggle in that environment, which means the NASDAQ 100 and NASDAQ composite, most likely it's a mean reversion. It's people buying on weakness in the short term, but overall, this would be an incredibly difficult environment for growth stocks to do well. So what happens right now is you have this interesting sort of disagreement between what I think you might be seeing on the chart. And I know a number of people, when I've posted something about this on social media, I get a lot of rise out of people, which is a telling, I think, indicator of its own. But if you look at the NASDAQ composite, you can see lower closes, January, February, March. We can see higher RSI, January, February, March. That's a bullish momentum divergence, which indicates prices going lower, but on lessening negative momentum. That's actually a bullish sign for the chart of the NASDAQ. So now we have both of those together, bullish momentum and potentially stabilizing prices for the NASDAQ composite chart, and the Qs look very similar to that, but you have the prospect of the headwind of higher rates. Where does this potentially net out? I think one of the potential outcomes is that the NASDAQ essentially just flattened down. While it maybe stops accelerating to the downside, it could be more of a choppy sideways period. The divergence that you're seeing shows that maybe the downside move has lightened up a bit. but the interest rate policy is not a great environment for these stocks to rally. I would also argue that this is also an exercise in timeframes. I could see a scenario where growth stocks actually bounce a little bit in the month of March overall before continuing a move lower, and you actually have a bottom a little later, maybe in the spring, and that would actually combine both of those. That would mean a bullish divergence actually plays out, but not enough to really be worth your time as a long-term investor. Those are the different ways that I would be thinking about the Fed's meeting today and maybe the longer-term prospects. I would remind you, even with the rally that we saw in growth stocks today, they still haven't even eclipsed their previous swing high. You would need to see that happen to really, I think, get more optimistic on the technical configuration of a chart like the NASDAQ. We need to move on to our next segment, which is ETFs engaged. We love to do occasionally is take ETFs and dig a little more detail about what we're seeing with that space. And again, I've been working more and more with individual investors and financial advisors. I find ETFs are such a fantastic way to get direct access to a lot of different markets. We're going to look at China right now. I'll start actually just to comment briefly on the Russian ETFs, only because I was interviewed earlier this week for a media outlet on the Russia ETFs, the RSX, and I will tell you that this sort of environment, what you have to remember when you're looking at any ETF, particularly a global ETF, an ETF or a product that tracks global stocks, is that you have to remember you are taking on a series of risks. When you buy something like the RSX in any environment, this the VanEck Russia ETF, and ERUS is I think that's the iShares ETF, if I remember right, covering Russia. You have to remember that when you buy an ETF covering a non-US equity market, you are taking on a series of additional risk. You're taking on the currency risk, which means whatever the Russian ruble might do is going to impact, or the dollar versus the ruble is going to impact what happens to your ETF. You're taking on country risk because now you're exposed to all the particular nuances and events particular to Russia and geopolitical risk as well. You're also taking on, as I mentioned, the geopolitical risk, right, and the military action or the atrocities that are happening in the Ukraine right now, certainly causing a lot of uncertainty and a lot of movement. So I find a lot of individual investors think a lot about the potential return on something like the RSX, which is why it's tempting to buy something when it's getting bombed out, because you think you could be getting in at a really reasonable level. The problem is when you do that, you're also taking on all those additional risk. And what we're seeing now is an additional risk called liquidity risk, which is when you want to sell something, is there a willing buyer that is able to sell it to you? And right now, all of these are halted right now because the Russian stock market remains closed. The RSX, ERUS, and others, options related to those have all been essentially frozen. They're all halted, so you're limited in terms of your ability to to make any sort of move in your portfolio. So the first part of ETFs Engage is just a lesson learned, hopefully not firsthand by you, on something like the RSX. But you have to remember that what's happening right now in Europe and with Russia and the Ukraine is certainly impacting the liquidity of a lot of these products. They're all halted, and you have to remember, if you get into an ETF like that, remember, familiarize yourself with some of those risks that you're taking on. Now, similar in terms of the technical characteristic would be the China ETFs. Now, obviously, these are not halted. These are still going on. They've all jumped today in a pretty significant way, and that's why I wanted to finish off here. So the FXI is the China Large Cap ETF. This is from iShares. MCHI is another ETF that I follow pretty closely. And they both have a similar pattern today. So the FXI is actually up 20%. What's interesting about the China ETF and also with a lot of the ETFs covering Asia and Europe, you have to remember that a lot of times these ETFs are going to be traded when a lot of the underlying stocks that they're holding or that you're getting exposure to are not actually trading, right? So it's an interesting exercise in trading a basket of things that are not actually being traded when you're buying and selling. It's one of the interesting developments in the ETF experience for individual investors. So what I would tell you about this chart from a technical perspective is all the China-related ETFs and indexes have been dramatically oversold. Obviously, a big regulatory component to the Chinese markets, and you've seen the prices deteriorate and accelerate to the downside. Just today, you're getting a huge change of character with a big bounce higher. What's interesting, though, to me, is that we're still not to the midpoint. If you actually take a regression channel, which is basically a best fit line of the closing prices, I'm starting the clock sort of at the market peak here in February of 2021, and I stopped the analysis here in mid-February to look at a 1-year period, and you can see this is sort of the best fit line in the middle, and then we're basically taking a series of bands based on the extremes. That's the highest extreme from that best fit line, so we're doing that on both sides. The sell-off that we saw in the last couple weeks has pushed the FXI and other Chinese ETFs well below that range implied by the regression channel. The big bounce that we saw today is still not even to the midpoint of that trend, and I think that's an important indication here, right? For me to get really interested in something, you'd want to see it start to rotate from distribution to accumulation. One day is really not a sign of accumulation. That's a sign of mean reversion. An extended move, putting in a higher low, getting above the midpoint of this regression channel, those would be the things that would start to tell you that the momentum is starting to improve. It's not just a one-day thing, but it's starting to show an influx of buyers that are showing a material change in the technical characteristics. So I would argue on something like the FXI, a lot to be proven yet, even with a big jump, and I know that's a significant jump. What you have to remember is we're still where we were a couple weeks ago, right? We still haven't regained most of the sell-off. We're about halfway back from where we were in early February. That's our segment, ETFs Engage, hitting on Russia and China ETFs and some of the challenges there from a technical perspective. Let's wrap today's show. Go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the S&P 500. I'm cheating a bit when I use the S&P chart as one of the 3 and 3, but I think it's at a really important measure right now. The RSI is right at 50. That is telling you essentially an absence of momentum at this particular moment. Tells you buyers and sellers are essentially in equilibrium. What that means is one of two things is going to happen. Either the S&P continues this bounce and powers through 4,400. That would take it above the swing high in March. That would take it above trendline resistance. Option B, we go below 4,200 and we finally confirm a breakdown through that level. I think which way we break will tell you a lot about what March and into April is going to feel like. And so I would be focused on that chart and some key levels. And again, I put a video or put an article on StockCharts.com just today addressing that in a little more detail. Chart number 2 is AT&T. I'm using underscore AT&T, so I'm taking the adjustments out. If you just do just the letter T and look at the adjusted data, you'll see that AT&T is at the lower end of the range that it's been for years, but that's because we're adjusting for all the dividends. Take the dividend component out, and if you look at just the pure price behavior, you can see AT&T has been in a fairly consistent downtrend for the last 6 years. Now, from a technical perspective, it is really hard for me to make an argument for owning AT&T here because I still would argue that this is in a downtrend. The reason why I'm highlighting it is two things. Number one, is this a double bottom that is starting to form? We were very oversold on the low there in October. We are not to the oversold level just yet, which means on a closing basis, we could be settling into a bit of a double bottom, which means if you would buy it here, you have a really clear level of downside risk. You have a place to put stops and make sure you manage your downside risk potential. The other reason why I'd highlight this is a dividend yield. AT&T is still paying a decent dividend. The challenge is the consistency and the ongoing nature of that dividend, which is the problem that I think a lot of investors will be facing looking at AT&T. But a blue chip stock that has tended to pay a pretty good dividend, potentially putting in a double bottom, may be worth paying attention to. Finally, Visa. Payment processors have been struggling, and PayPal has been one of the example charts of, I think, the weakness in that area of the market. Visa has bounced off of its 50% retracement level, now back above Fibonacci support here. I'd look for a stop around 206. Can it regain the previous highs around 235? Ladies and gentlemen, that is our show for today, and a wrap for this show. I want to thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.